Welcome back to the beach and Money Life at Future-Proof Citywide. We had told you what we were going to have in terms of some of the guests that were coming on the show, and I had not included our guests because we kind of were able to get this done last minute. But you've heard him on the show before. Barry Martin is manager of the Shelton Equity Income Fund. That's EQTIX if you're looking at the ticker symbols. If you want to find out more about the firm, it's sheltoncap.com. If you want to find out more about the fund or the funds in general for them, it is sheltonfunds.com. Barry Martin, great to do this in person.
Yeah, good to be here, Chuck. Thanks.
I think it is safe to say, as I've been hearing like surprisingly good things about bonds, bonds are in a sweet spot right now. Now, not that that's necessarily surprising, but we're at a conference where the equity conversation carries the day. It's what everybody wants to talk about. But yeah, circumstances for bond investors kind of gotten really juicy here for the last couple of weeks, haven't they?
Yeah, and I think, it goes back to 2022 where people were sick of bonds and the 60-40 portfolio where the correlations approached one between bonds and equities. But now we're seeing that go negative, and that's what bonds are supposed to do. You have bonds for safety and income, and then you have equities for a little growth. So yeah, bonds are definitely attractive right now. We do something a little bit differently. We're mainly focused on covered call writing. I think bonds are great, but also with this elevated volatility, covered call writing makes a lot of sense as well.
Well, and I want to talk about that as well, because that's been a big part of Future Proof has been, let's come up with better outcomes or what have you. And with uncertainty, investors historically are willing to trade. I'll give away some return if you can just make it that I know what I'm getting for sure. And so they're looking towards other things, including some of the covered call fund. How is that working? Because there's so much product proliferation that it's tough to tell one from the next.
Yeah, I mean, we're seeing a lot of people start using in derivative income strategies. I believe it was the second most popular Morningstar category last year with inflows. And since 2020, there's been over $200 billion going into the category. So it's been a crazy ride, but it finally might pay out for like a year like this where the VIX is elevated. I think we're in the mid-20s now. We're having our own little March Madness before the actual tournament. But so you're seeing volatility be used almost like an asset class where we're not trading vol, we're just using the vol and underlying equities to risk manage the portfolio and generate some cash flow as well.
How much volatility, extra volatility, should we be expecting from the bond market at a time when we now have potentially rate cuts back in the picture more than we expected them to, but we also have all of the governance things that are not only injecting uncertainty, but for tariffs to work, we need a weaker dollar, which we don't. The weaker dollar doesn't directly impact bonds, but it certainly indirectly impacts them.
Well, yeah, I mean, the great thing about bonds is you look at rates and pretty much everything impacts, fixed income side. So, you're seeing volatility there. And, I just think that in general, it goes back to 2022 where the correlations were approaching one between bonds, fixed income. And you're starting to see that reverse. And that's where bonds are really, adding value to one's portfolio.
Let's go back on that as well, because the covered call layer here is designed to make sure that relationship stays the same.
Yeah.
That we're staying with an inverse between stocks and bonds, basically. But given what happened in 2022 and how unusual it is it the anomaly and we wouldn't expect it to happen again? Or as we watch what happens next, could we be in a situation where we quickly again find that stocks and bonds are too correlated? And I mean, that helps you in terms of what you're doing, but investors who don't go in this way are kind of like, oh, you didn't learn the lesson the first time?
Yeah, exactly.
The beatings continue.
The beatings will continue till the morale improves, right? As they say. So we look at covered option writing almost like a third prong to the stool. It's important to look at one's overall portfolio and adding it to an overall portfolio, reducing the overall risk. So we're starting to see advisors take that part of their 60-40 portfolio and taking maybe a 10% fixed income exposure and another 10% equity exposure and creating a new slice of the pie. So now you're starting to see 50, 30, 20. And I think you're going to start seeing that more often. I mean, we're at a conference today, this weekend, where a lot of the talk is alternatives and different approaches to manage portfolios. And so really thinking about the portfolio overall and having a different return pattern added to the overall portfolio reduces your overall risk. And I think that's super important, especially at times like this where volatility has expanded so much.
So I'm going to ask a question that might be considered a little bit blasphemous on the investor side, because we always want people to buy what you know what you buy, et cetera.
Right.
But nobody wakes up in the morning and goes, okay, I need a loaf of bread, a thing of milk, and I need a bond strategy that involves covered calls. Like, they're not buying that. And in fact, the worry that we have as we have these conversations is how quickly do they tune out if that's not something they're interested in. Yeah. And yet, very smartly, their advisor should be offering them a variety of products, which might include something like this.
Yeah.
How much does the average investor have to just kind of come up and say, what I want is the expected return and the fund to perform the way I think it will, and worry much less about what the fund is doing to get from here to there?
Yeah, and I think the job at advisor and the job for people like us is for the client or the end user to be able to be in the game but sleep well at night. And so I think when you're looking at a holistic approach to one's portfolio, it's really important to look at the risk and trying to reduce that as much as possible. And I think when you're adding, our standard deviation is roughly a third less in the market, but we have equities in our portfolio, so we still see some growth. These type of strategies that we employ maybe don't go crazy in upwards markets, but when it's choppy sideways or slightly down, they work really well. And I think for us, it's educating the advisor and educating the client of what you expect in different types of markets. So with our covered call writing program, and it does very well in choppy sideways markets because the premiums we receive for selling the calls is the main source of total return. And in a down market, those premiums now become a cushion and protection. But in upwards market, that's where we slightly underperform because you're selling away the upside. But in times like this is where we really add benefit. And I think when you're looking at holistically and adding certain different things to overall portfolio, it really makes a lot of sense.
Ultimately, as you pointed out, tons of money is flooded in here, which is why there have been tons of new funds, etc. If the fund world were a meritocracy, and it isn't, 60% of the funds in pretty much any category would be gone tomorrow. Do we wind up in a situation where, whether it's because of performance or just because it's hard to attract the guys who are here to do your product, that you expect that, congratulations, there's a lot of new products, but 2 years from now, if you come back to this, you will not see a lot of the same competitors?
Yeah, so it's interesting. So and we're in the derivative income category, and we're 5 stars on Morningstar and gold rated, so hopefully we won't be gone. But we've seen the Goldman Sachs, the BlackRocks, the JP Morgan obviously makes a huge splash in the category, but it's more a confirmation of what we're doing. And so I've been doing this for over 25 years, and it's finally nice to have the wind in our sails. But you're right, there is a level where it will get oversaturated. I mean, I'm seeing covered call funds start almost daily, and there's a covered call fund, only Apple with covered calls. That's it. It's kind of interesting. We're seeing that across the board with ETFs. Obviously, you have themed ETFs, you have index ETFs, you have all these different type of ETFs coming to the market. How many of those will be here in 2 to 3 years? I don't know. They're expensive to run, so we'll see.
Yeah, well, we will see. Again, you've got the track record that you should be one of the ones that's still standing, but right now you still got to beat back the rest of the crowd. And you mentioned wind in our sails for your fund. Well, the wind is in our ears and our sails and everything else here at Future Proof. Thanks for sailing in. We'll let you sail out now.
All right, thanks, Jack. Appreciate it.
That's Barry Martin, manager of the Shelton Equity Income Fund. It's ticker EQTIX. SheltonFunds.com for more on the funds. SheltonCap.com for more on the firm. And speaking of more, there's more of Money Life at Future Proof Citywide in just a moment.